This is Chicago's Morning Answer with Dan Proft and Amy Jacobson on AM 560. The Answer.
Top of the morning, Dan and Amy. So the December jobs number is out. Hiring slowed, 199,000 non-farm payroll increase in December. And it's basically more or less the same old story we've been telling for the last few quarters, which is modest job growth, wage increases, but not keeping up with inflation. And speaking of inflation, the Eurozone reporting yesterday 5% inflation, again, another recent high. So transitory inflation continues to not be transitory. To distill this information and fold in some of what's happening in the markets as well, pleased to be joined by our friend James Perry, who's the Senior Vice President and Partner at Arbor Research. Jim, thanks for being with us again. Appreciate it.
Thank you, Dan. Good morning.
So I think we've established long ago, including with our friend Scott Shalady, the cow guy, that the unemployment percentage is a meaningless statistic. Dropped to 3.9%, but again, hiring slowed, 199,000 new jobs. Is there anything in the tea leaves to properly read from those numbers?
Well, the numbers are skewed and they're not particularly insightful. But I think when you look at these non-farm payroll numbers that come out every month, you really have to look at the trends because there's so many revisions. And I think that if you kind of take a step back and look at where we were before the pandemic hit, we're still sort of something on the order of 6 million, 8 million jobs short of where we were 2 years ago at this time, January of 2020. The workforce is something like 155 million people. And in the last 12 months, Dan, what you get from some of these other surveys, especially earlier in the week, 4.5 million people quit their jobs in November, right? And that's about the pace it's been going. That's a little bit higher than every month, but there's something like 25 or 26 million people quit their jobs in 2021. That's the trend. And the trend in the workforce, what you have to kind of look at is say, well, what's been going on for 20 years and what has accelerated it since the pandemic? And what has happened is that the labor workforce, the number of people that are actually working, is falling. It's 61% of the working population.
Right, but
so,
why?
And those trends are going down.
I'm sorry for interrupting, but why is it falling? Why did 4.5 million people quit their jobs in November? Just didn't want to work anymore?
For it, Amy. Good morning, by the way, Amy. Nice to hear your voice. I hope you're feeling well, or better anyway.
Thank you.
I think that there are a lot of reasons why people are quitting. I think largely people were in jobs that they didn't particularly like, 2 years ago, and they don't feel like going back. And I think there's a certain wealth effect from people. I mean, everybody's house is up 20% from 2 years ago or more. And the stock market's up, it's doubled since the lows in March. So I think people have savings. I think they've got net worth in their homes and in their 401k and their portfolios, if they've got any savings. And I think people are thinking about being a consultant and working at home and doing things that doesn't mean going to the office.
Well, not everybody's home is up 20% year over year. I note that.
Us in Illinois.
The October number, this is remarkable, actually, and it gets almost no attention except for me. But the median home price increase in the country, October of 21 over October 20, the median home price increase, 18%. In Illinois, minus 6%.
Ooh.
For sure. Count me in on that category. I mean,
that's we're only lagging the nation by a factor of 4. Yeah.
Right. And expect that to continue, by the way.
Well, and this is what, and just to get in the real estate market, we can segment this a little bit. This is what Zillow was reporting as well, that, in terms of what they predict to be the hot housing markets in 2022. And, you won't be surprised that they're located in places like Florida and Texas, and they are talking about a continued cooling off, as if it could get cooler, in places like New York, San Francisco, and Chicago.
Correct. That trend is with us and is going to continue.
And so what does that mean, both on the residential side and then now layer in something I talked about earlier this week with Steve Moore, the commercial real estate vacancy rates in big cities, the Class A office space, you put 18% vacancy rate in Manhattan and 25-30% in New York, in D.C., in San Francisco, in Chicago, in Houston.
Right. I mean, I think that there's a lot of statistics and a lot of it's easily misread. But, again, the trends are that if you're in an urban center in a high tax city like Chicago, you'll see that commuter traffic is down substantially, Metro Rail and the subway and the buses. But the highways going into Chicago from sort of, around O'Hare and in, they're packed every day. So everybody's driving their cars to Chicago. And once you get down into Chicago, it's empty, right? So
right.
The commercial real estate space in the city of Chicago, which I know better than New York and San Francisco, is in trouble. And I think that there will be significant challenges for commercial real estate owners to continue to service their debt. And I think that this is one of the reasons the bond market is still in pretty good shape here, and the stock market looks like it's going to try to flounder.
Well,
I think what's happening is that the Powell Fed has had to talk tough on inflation because the approval ratings of the administration are falling, and the number one reason for it is the higher prices that the average guy is paying for food and energy. And that is a very big deal because it reduces disposable income. So he's talking really tough on inflation. The market's pricing in an 80% chance of a rate hike in March and 3 or 4 rate hikes over the next 12 to 15 months. Yet long bonds are still at 210, right? They're and 5-year notes are at 1.5%. So and the inflation-linked bond market is underperforming nominal. So this is really a story about real yields and the Fed starting to reduce stimulus at a time when the economy is slowing. And there are huge portions of the economy that are underperforming massively. And I think that if you get a rate increase of some kind, you're going to see the premiums in real estate and the stock market come down because consumer demand is falling in the face of higher prices and wages not keeping up with those price increases. So you're getting disposable incomes, which are falling. People don't have disposable income.
And over the last couple of days, we've seen a pretty significant sell-off in tech. And I wonder if we're on the cusp with all those other variables you mentioned, the removal of the candy from Jay Powell and the Fed, if we're on the cusp of that 20, 25, 30% correction in the market that so many financial analysts have been predicting for about the last 3 quarters.
Right. Well, you're already getting it, really. I mean, 35% of the total return in the S&P 500 in the last 12 months has come from 5 stocks, right? And there's something like 40% of the S&P 500 stocks, 50% of the NASDAQ has come down about 40%, right? So all of these sort of storied dust fairy stocks that are making money, these are the high beta stocks, they're getting killed. Rivian being a classic example, right? This stock is making another low today at 87. And the reason for it, it's got a $100 billion market cap with no revenue. So people are already selling stocks that they're worried that are in the tech space with no earnings. And just back to your point on technology, the big cap tech stocks are what they call long duration assets. And that means that the cash flows of those companies are being priced in for 5 and 10 and 15 years from now as the cloud continues to expand. So when the high duration tech stocks are overvalued, they get hit the hardest because you have to discount those future cash flows with a higher cost of capital. And I think that right now, the stock market is vulnerable to kind of a price earnings multiple contraction because the forecasts for cheap money are gone. You've got a Fed here. You've got a Fed Chairman Powell is an inflation fighter right now. And whether inflation is transitory or not, the fact is that he is going to force rates higher by reducing his bond purchases, and that's going to put pressure on the stock market. That's his idea. His balance will be do it enough so you don't get smacked too hard and throw yourself into a recession quicker than you're already going to have one, because we will.
So we've also seen Bitcoin get hammered this week. It's down just north of $40,000 last time I checked.
Right.
And you had an interesting piece on for your subscribers about Bitcoin and trying to sort of understand what it is as an asset. So if the stock market is looking for that contraction, looking to a contraction that you described, and how are we to understand cryptocurrency for those that may, last year sort of started to wade in a little bit and devote a few points in their portfolio to crypto? Is that still going to be a safe haven? Is that going to be something that runs counter to any sort of market contraction, or is it going to run in parallel?
Right. I don't think Bitcoin's a safe haven. I don't think it's a hedge against anything. I own some. I've owned some for a long time. I own it because I want to follow it and learn more about it. And the more I study it and read about it, which is every day, what comes to me is that, Bitcoin isn't a currency or a gold hedge or anything like that. Bitcoin is a software company, right? I mean, you earn Bitcoins by processing information on the blockchain, right? And the blockchain is growing exponentially. So the blockchain is going to be with us forever, and it's going to be ubiquitous, and it's going to save a lot of money, and it's very deflationary. But people get paid in Bitcoins for processing information on the blockchain. And, so in that regard, it's kind of like a Microsoft, I mean, Bitcoin is a software company, and to buy a Bitcoin as a hedge against inflation doesn't make any sense to me. And to buy it as a safe haven against the depreciating currency doesn't make any sense to me, because you'd be better off buying Microsoft, right? So I think it's greatly misunderstood.
Then why are all these Bitcoin kiosk machines popping up everywhere at gas stations and convenience stores? What's that all about?
Well, I think to my point about the blockchain is, small businesses are the ones that are getting hurt the most, right, in this post-pandemic reopening. They're faced with increased costs in materials and in labor. So if they can do anything that allows technology to help them reduce their costs in delivering their product or service, they're all for it. So if they can have somebody come in and buy their product on an app and pay for that product on an app before they get in there, all they have to do is pick up that product or service and go. So a Bitcoin kiosk allows small businesses especially, to reduce the cost of making a transaction, right? So I think it's about cost cutting.
But by the same token, it seems that Bitcoin is here to stay, and I certainly the underlying blockchain technology is. This week, BTCS announced they're going to pay corporate dividends in Bitcoin. They're calling it which is NASDAQ listed, by the way, BTCS. They're calling it a bividend. And so there's a belief among the crypto nerds that this is more evidence that Bitcoin is inevitable. Maybe that's true, but if it's like Microsoft, which stock price is a little north of $300, it may be inevitable, but may not be trading at $40,000.
Well, that's right. I mean, if you look at the 2008 and 2009 downtrade in technology and the 2000 downtrades, I mean, Amazon at the time was something like $150 a share, and it went to 10. I mean, you could have these big cap tech stocks come down a huge amount, and Bitcoin could come down 50% too, because you don't really know what it's worth. I own it. I'm glad I own it. I'm glad I'm watching it. But it could go to 100 or it could go to 20,000. I don't know. I don't think anybody knows.
If it's more like a software company, and again, the technology that undergirds it, that blockchain technology is the real value, then are there other cryptocurrencies that you're watching that have more upside potential because they're going to be able to leverage this technology to do more things than Bitcoin does?
Right.
Microsoft gets displaced by competitors.
Yeah, that's a very good question. I mean, it kind of reminds me of the early days of the sort of, mini computer. We didn't know Apple was going to emerge as the company that made the most smartphones, right? There's a lot of companies out there that were making small things. And I think somebody and one particular or two or three particular technologies in the crypto space will be dominant. I'm just not sure it's Bitcoin or Ethereum or any one of them. I'm not an expert on this stuff. I don't know enough about it. I do know that the technology is changing so quickly, and with the use of artificial intelligence, these systems, these software programs that helps the processing of blockchain transactions is getting better and better and better. So it's coming. I just don't know which cryptocurrency or which platform is going to be the one that emerges as the Apple, in 10 years from now, like Apple did from 10 years previous to now,
Well, if there's concerns about crypto and there's concerns about a market contraction, and the real estate market, at least in some regions, big regions of the country, is going to cool off significantly, where should people be thinking about putting their money? Are we just supposed to buy used cars and cargo containers?
Right. That's a very good question. I get asked that all of the time. And I think that if you look from the standpoint of a wealth manager who's got a portfolio that, is balanced between stocks and bonds, that sort of traditional 60-40 mix between stocks and bonds, I have one of those. And right now I'm 30% invested in the stock market versus 60, right? And I've got that mix between the S&P 500 and the NASDAQ 100 QQQs, less financials, right? I still think that technology space is going to be a good one. And if it gets to go down 15 or 20%, I'm going to buy some more. But I'm 30% cash. And to be honest with you, a lot of people, a lot of your viewers might disagree with this, but I think long treasury bonds are a really cheap investment here at 2%. Real rates are negative all over the world, Japan, Europe, and here. And if the Fed is going to try to reduce the negativeness of real rates, which is what Fed Powell is doing, then, nominal bonds are trading better than inflation-linked bonds right now. The 30-year Treasury from October 25th to the end of the year returned 4.5% total return, which was more than double the amount of index-linked bonds at the same period of time, right? So I think now that we've had a little pullback in bonds, and I'm not sure how cheap they're going to get here, but it seems to me that by having a balance between a long treasury portfolio and an S&P technology sort of concentrated equity portfolio is probably the best barbell approach to seeing the multiple expansion in the broader stock market come down. I think there's a lot of other things in the economy that can get hurt. This Omicron deal is going to slow us down again. I mean, I don't know how much traveling you do, but, airplane tickets are really cheap again here. My son just came down from Chicago the other day, and he paid $40 for his flight. Wow. And, 4 weeks ago, it was $400. So, and I was telling Quinn earlier, these cruise ships that go past South Point here, I see them every day when I'm running in the afternoon, and they're empty, man. So the travel and leisure sector and the fact that demand, again, GDP is 2/3 consumer spending. And if taxes are going up and food prices are going up and gasoline prices are going up, disposable income at the household level is falling, and that means GDP is going to fall. So Q1, Q2 GDP probably back down to trend growth pre-pandemic, which is kind of 2%, right?
All right.
And if you're going to get a GDP growth number of 2%, then your inflation numbers are going to come from whatever they are, 4.5% back down to trend growth pretty quick here too. This is what the market is telling you right now.
All right, good time to book a flight to Florida and get on a cruise ship around the world and come back in 2023 and see if it's any better. Jim Perry,
Exactly.
Senior Vice President, Partner at Arbor Research. Instructive as always. Thanks, Jim.
Thanks, Dan. Have a good one.
Thank you. And he joined us on our turnkey.pro answer line.
Before you see it on TV, share it on Facebook, or read about it in the paper. Hear it here first. This is Chicago's Morning Answer on AM 560. The Answer.
Sean Thompson here to tell you about an incredible cost-saving opportunity you should consider for